lost you for a second. The first question I wanted to answer was, where did this webinar come from? And I suppose there are three answers to this question. First of all, speaking as a financial professional in the accountancy industry, I know that financial reports, the financial figures in general can be quite intimidating. I mean, I've sat in plenty of year-end meetings and audit close-down meetings where the accounts are kind of thrown over to a client and their eyes kind of glaze over and they look horrified because they don't know what on earth they're looking at. And I just feel like it's not a particularly fair way of going about it, this expectation that you're an expert on the financials, and it's worth kind of going into the details of what you can get out of them. Secondly, I don't think a lot of business owners are necessarily aware of best practice when it comes to financial information and what these reports, how important some of these reports can be to you, and gleaning information and data out of the health of your business, especially when it comes to sort of budget and forecasting rather. I don't think a lot of people are aware of necessarily the benefits of them. For those who are doing forecasting and budgeting, you're probably thinking, Jack, blooming heck, the figures I pulled together for the past 12 months do not tie up to what I was expecting, and they're not even worth the paper I'm printed on. What I would say is persevere, and obviously we can help with that. Even on a rolling basis, it's worth kind of measuring those budgets and forecasts. And finally, one of the business accelerator department, kind of the cornerstone of what we think is behind a successful business, is access to accurate and up-to-date information. And I apologize in advance because I'll be banging on about this quite a lot. But ultimately, having up-to-date information which is accurate will help you make informed decisions. Compare your results, period on period, and ultimately help you benchmark yourself against your competitors. So, without further ado, we'll just get cracking on with the session. To start off with, always like to share a little thought for the session to kind of get us in the mood. So this is from Barack Obama. A budget is more than just a series of numbers on a page. It's the embodiment of our values. Now, I suspect it may have been taken slightly out of context because he's probably talking about the US federal budget. However, if it's good enough for the so-called best democracy in the world, I'm trying not to get too political, obviously with the American politics going on at the moment. But if it's good enough for them, it's good enough for us and our businesses. Sort of two words jump out to me at the outset of this from this quote, and it's kind of the word budget and the word values. Now, budgets to me kind of show ambition and direction and a desire to improve within a business. It also shows they've got indications of good controls in their business, and there's some semblance of accountability, which we consider very important. Is ultimately it kind of sets out on paper your expectations for the performance of your business over the next 6, 10, 12 months in the future. And it also gives an idea that if you don't meet those targets, then I'm sure you're going to do your damnedest to understand what's happened and why you haven't reached what you were expecting. Values, I think they get quite a bad press in general. I know I'm probably among many of you who kind of mock the irony of some of these larger businesses and their values. You have like fast food outlets and fast food providers who value healthy eating while simultaneously selling food, which is sort of 80 or 100% of an individual's average daily intake of salt and fat. Similarly, on an SME level, I feel like they kind of pay lip service to them. It's kind of tucked away on a lot of people's somewhere on their webpage, that they're not really brought to the front and center. I mean, here at Robson Lady, we've just done a really big piece on our values, kind of collating all of our staff's input into what we feel like our values should be, and that's kind of setting down our culture and obviously our business practices, and we're trying to actually assess our performance against those values. And I feel that's where it should be. And ultimately, every single member of staff within your business, be a business owner, a senior manager, or a new starter, should really filter into those values and it'll ultimately determine quite important things within your business, sort of why you do what you do, who you sell to, who you buy from, how you conduct yourself, and your expectations of like how other staff members should behave around you as well. And I feel like a business which doesn't reflect those values can reflect the values of their staff can struggle. Sorry, getting a bit sidetracked again. So onto the agenda. We'll fly through this. So over the next 40 minutes or so, we're going to be looking at why we need to do the maths. We'll be overviewing the kind of 6 key reports that every business should be preparing and reviewing on a regular basis. Understanding the difference between profit and cash. Understanding what the key drivers of business value are, as well as looking at ways to protect our assets and adopting best practice. And then hopefully at the end, we'll talk about some potential steps that we can do to follow on from this webinar, as well as answer any questions. So make sure you take plenty of notes. I'll apologise in advance for any of the jargon that goes on, but I'll try my best to explain everything clearly as possible. And as Gemma said, if you have any questions throughout, just raise your hand or ping them into the chat bar, and we'll try our best to answer them as and when they come in. So, first question, why do we need to do the maths? Well, there's probably quite a few reasons for this. Firstly, the numbers tell their own story. I mean, admittedly, there needs to be some interpretation, which will take a bit of time to understand, but fundamentally on a high level, they provide like a definitive comparison. Sales have gone up or they've gone down compared to last month. And this is kind of when we have to ask ourselves why that's happened. Sales have gone up because we've got that new contract that we won. Wages have gone up because we need to employ a new employee to service that contract. And overall, it looks like we're still making a profit overall. Stuff like that on a very high level. Secondly, figures flag up underlying problems which need to be addressed. So the symptom of an ineffective pricing system, for example, would be a gross profit margin which is continually falling. And if your business is making a habit of actually constantly reviewing that metric, then you'll be able to identify that there's something wrong with your pricing, which then you can address. Thirdly, the figures are almost like the radar to your business's Battle of Britain. Sorry, a bit of a tenuous link there. But if we think about credit control, for example, if you don't actively keep up-to-date records or monitor your debtor position, you may receive a massive order which comes in from your sales team. Excellent, fantastic news, huge order. Let's clear the order book, let's get the materials in, let's start working on it straight away. However, maybe if you had been checking your debtors, you realise that this customer that's put this massive order in hasn't paid an invoice for the past 6 months. And maybe there's potential that you're going to lose quite a lot of money here because they're not going to pay this invoice either. Fourthly, it highlights areas of strength because ultimately the numbers rarely contradict reality. I mean, the basics of cash flow management and improving your cash flow is that if you can increase your sales and get your debtors to pay you quicker while simultaneously slashing your overheads and increasing your credit terms with suppliers, your cash flow's going to improve. And if it doesn't, then there's either something wrong with the numbers, something's been put in wrong, or someone's stealing money off you, potentially. And finally, knowledge is power. Ultimately, the more you know about your business, the better. You know, we're talking small things like what comes out of the bank on a monthly basis via direct debit. When do I pay my pay-as-you-earn submission? When do I pay my VAT return? Ultimately, so the more you know about it, more you know about potential areas of difficulty that are going to be coming to the business. So if we look onto these are the key reports that, as I said, that all businesses really should be preparing and reviewing on a pretty regular basis. We're going to work through kind of some illustrations of each of these reports, and then obviously we can point out some key learnings and things to look out for. Our example company is rather imaginatively called Foodco, which is a food manufacturing company. No prizes for originality there. So the first report we're looking at is your trading account. And this is essentially where you're tracking your sales and your costs associated with producing and distributing your products and services. It's also where you'll be tracking your margins, both on a kind of overall high level and a more granular level, such as by a product basis. Monitoring your margins is vital, and it's a key indicator of the business health. I'm sure you'll know that squeeze margins, and you've experienced this firsthand, squeeze margins can have a knock-on effect on both your profit levels and the cash in the bank. But we don't necessarily need to be looking at your trading account purely on a product by product basis. You can split your trading account any way that you like. You know, some businesses will be doing it by a geographical location, you know, either on a branch, if they have multiple branches across the region, or if they're more national, then they're looking on a regional basis, or internationally, country by country. Alternatively, we can be looking at departments within a business or divisions. For those of you who are familiar with Xero, the accounting software, you might well be aware of the tracking functionality within there, which offers basically a way of splitting down your trading account into any kind of way that you please, that you want to track your business. The important thing to note is that the trading account obviously keeps account of your total trade over a period, so it's going to include every sale, every purchase of stock, every courier and haulage that you've used, and obviously these figures add up over time. So it's important to bear in mind that small adjustments sort of in percentage terms can have a huge impact on your overall results, as we'll see in the next slide. So here we have our trading account for Food Co. And as we can see, we have sales of around about £1 million, cost of sales of around about 318,000, which giving us a gross surplus of 700,000. There's also direct costs of 450,000, which is contributing to an overall gross surplus or gross profit figure of £248,749, and a gross profit margin of 24%. So let's say, for example, Food Co. go and speak to their accountants and they say, we want to improve our cash flow and we want to improve our profitability. So the accountants go away and they have a look and collaborate with the directors at Food Co. and they come up with 3 potential areas of improvement within the trading account. First of all, they noticed that the sales that they were making were primarily to one-off customers, and they weren't retaining many orders after the first order. So they started looking at strategies to improve their customer retention rate, and that resulted in a 10% increase in sales. Simultaneously, they noticed that there was quite a lot of wastage in their inventory processes, and quite a lot of the food that they were buying was going out of date while it was in the warehouse. So they helped them revise their inventory processes and when they buy stuff and how long they store things. And finally, they've also noticed that one of their couriers was charging them an extortionate rate for their deliveries, and they renegotiated a contract with them, resulting in another 5% reduction in direct costs. So if we look at that overall, we can see that there's quite a remarkable result here. And relatively small, if we can agree, relatively small changes in terms of percentages can result in quite big figures, you know, on the bottom line. If you see that now the gross surplus is now 389,000, which is an increase of 140,000. And more importantly, gross profit margins increased by 11% to 35%. So what I would say is understanding your trading account allows you to identify areas where small improvements can have big impacts on the profitability of your business. Now, this is one I'm sure you're probably all familiar with, the profit and loss account. So also known as the income statement to some people. This includes your trading account, but also factors in your non-production expenditure, such as your indirect wages, repairs and renewals, and depreciation, etc. And ultimately, these are deducted to calculate your overall performance in a given period, either on a monthly basis, or a lot of people will be bearing their annual accounts, will be looking at their profit and loss account. One thing to note is this matching of income and expenditure. It's an important kind of accountancy point, but ultimately it makes a lot of sense in terms of matching your income and expenditure. If we use an example where Foodco, for example, inexplicably received money in advance for an order in November 2020, but they didn't start production until December 2020, then their financial figures will look very odd because their November figures will show a significant profit. Meanwhile, their December figures will show a significant loss. So in reality, when we're preparing our profit and loss account, we always make adjustments to kind of match off income and expenditure to the point where they actually, match up. The profit and loss account also is a standardized framework for businesses to benchmark their performance. This can either be done internally, and people compare their performance on a month-by-month or a year-by-year basis, or as the fact that it's a standardized report, you can also go out and, if you can get access to it, benchmark your performance against competitors either on a local or a national level. Also, the last thing to note about the profit and loss account is that it's very important for when you're selling your business, because generally businesses are valued on a multiple of their earnings. So the profit and loss account becomes a fundamental driver of your value. So the higher profits you have, the more value you have in your business. Makes logical sense. So here we have our profit and loss account for Foodco. As you can see, we've got the gross surplus from our trading account, which we've just done, and we've also got all of our expenditure that they've incurred, and we've also netted off the owner's remuneration at the end. And as we can see, they're currently making a net loss of 113,000. So let's say these trusty accountants have come back in for Foodco and they've identified 2 other areas within their expenses where they can reduce costs. So they've seen that they've made an introduction to an insurance broker to them, and they've managed to cut 5% off their insurance fees. And likewise, they've encouraged their Foodco to go and negotiate their rents with their landlord. Obviously, COVID is probably the best time to go out and speak to your landlord and see if you can get some money off your rent. And that has resulted, in terms of actual money, cash money, is that there's been a reduction of insurance of around about 590 quid and a reduction in rent of about £3,000, which isn't too bad. I'm sure it hasn't escaped your notice that accountancy fees have gone up. Unfortunately, these accountants, they don't do stuff for free, so there has been an increase in it. However, even if we factor in that increase, as well as including the savings made in the trading account, they're looking at an improvement of around about £138,000, and more importantly, move them into a profit-making position of £24,000. So, next up, the balance sheet. Again, probably another report that some of you are quite familiar with, also known as the statement of financial position. This provides more of a snapshot into a business at any point in time, which is different to the P&L, because the P&L is monitoring your performance between 2 separate dates, be it between the start of the month or the end of the month, or being the start of the year or the end of the year. The balance sheet also differs as it looks at the financials in terms of assets and liabilities as opposed to profitability. And this gets us onto the idea that the balance sheet measures the solvency of a business, which is the ability for a business to pay their liabilities as they fall due. So if we have assets which are more than liabilities, more assets than liabilities, then a business is solvent. Now, I appreciate that the term solvency or insolvency, more to the point, is quite scary because everyone assesses. Everyone assumes, rather, that the negative connotations of insolvency. You think that you're going to go bust, and that's not all necessarily the case. It's not as if as soon as you fall into an insolvent position that your accountant rings you up or your bank manager rings you up and tells you that you're insolvent and we're going to close the business down. That's not the case. You don't need to worry about that. In fact, there's probably a case where quite a lot of businesses are in almost a false insolvent position because the money that's owed, the liabilities that are owed by the business are generally to the business owner or one of the directors, which you wouldn't expect them to be chasing that money. A lot of these loans don't have any contractual repayment dates, so they never really fall due. In which case, it's kind of skews the figure of the solvency figure of the business. The balance sheet also is another standardized framework, which you can use to compare both internally and externally. Obviously, increases and decreases within the balance sheet figures and the net asset figure, which we'll look at, obviously indicates indicates the health of the business and if it's improving or weakening. As expected, the strength of the balance sheet is kind of measured on how much your assets outweigh your liabilities. And in the case where you have a strong balance sheet, it generally indicates that the business is more likely to survive an economic downturn, which obviously makes sense because you're more likely to have high levels of cash or debtors, which can kind of service your cash needs whilst your trade's fallen. And obviously that additional cash can be used to service the debts as they fall due on the liability side. I deliberately kind of avoided including inventory or stock within that figure because stock's a bit of a misleading asset, because it's quite difficult to liquidate, because obviously if you could sell your stock, then you wouldn't necessarily be in a position where you were suffering from the economic downturn. Finally, the balance sheet's also where you can glean some excellent insights into your business through the various ratios, which we're going to have a look at in the next slide. So as you can see from the balance sheet for Foodco, the business is currently insolvent. We're also looking at negative working capital, as we can see that our total assets are 138,000. whilst our current liabilities are 162,000, which essentially means that the cash and the debtors and the inventory value isn't enough to service the current liabilities as they fall due. As a result, the business actually needs to act fairly urgently and get an injection of funds to the tune of £305,000, and this can either come from share capital or a shareholder loan or director's loan, or even possibly through a more traditional bank loan, although the balance sheet may make that quite difficult for them to get funding. Assuming that the company can resolve these urgent solvency issues, then there are some other areas of improvement that we can look at. So on a more longer term, the business can look at ways of improving their debtor days and their inventory days. And if we look, and we can just look at what that actually means. So debtor days are calculated by dividing your debtors balance by your sales figure in the profit and loss account and timesing that by 365, obviously the days within the year. And that basically tells you how quickly that your debtors are paying you. So in the case of Foodco, they're currently their customers are taking 26 days to pay them, which isn't actually too bad in reality. And it's interesting, if Foodco could find a way of improving their debtor days by as little as 5 days, and this can be done through a number of ways, such as redrafting your terms of trade to reduce your credit terms that you're offering customers. If they can find a way of improving that by as little as 5 days, then that could free up to almost £14,000 worth of cash in the business. Likewise, inventory days, and this is calculated by dividing your inventory balance by your cost of sales figure and timesing that by 365 rather. And this ultimately tells you how long you're holding stock for until you sell it, or another way of saying it is how much cash is tied up in inventory at the moment. And again, if the directors could just find a way of improving that inventory day by as little as 9 days, and again, they can maybe look at the inventory processes that were suggested to them by their accountant when they were doing their work on the trading account as a possible way of going about it. If they can, anyway, if they can improve that by as little as 9 days, then that could free up almost another £8,000 worth of cash. So although there's £22,000 through improvements through debtor days and inventory days won't necessarily improve the more urgent cash solvency issues regarding the £305,000. It still kind of highlights, areas of improvement that it can be made just by, speaking to your accountant almost. Next up, we have the statement of changes in equity, and this essentially tracks what happens to your profits that are accumulated, ever since the business has started trading. And ultimately, there's two things that can happen in a statement with the statement of changes in equity. First off, they can either be paid off as dividends or they can just be retained within the business. Ultimately, the statement of changes in equity is a mirror image of the balance sheet. We saw that the balance sheet went up to net assets, and essentially the formula is that assets less liabilities will equal equity, hence the term that the balance sheet should balance. Therefore, it represents the net worth or the value of the company as well in the statement of changes in equity, and is obviously another key indicator of the health of the business, and also indicates the solvency as well, similar to the balance sheet. Important to note that the solvency of the company also has a knock-on effect in terms of dividends, as it's important to note that you can only pay dividends out to shareholders if you have positive in your statement of changes in equity. So if we look at the example of Foodco, what we can deduce is that they've made losses for at least the past 3 years, which ultimately means that there's no retained earnings and the company is largely insolvent. That means there's no money to pay out for dividends. There's no money to reinvest in the company to grow, invest in new assets, for example. And ultimately, the directors kind of need to take fairly urgent action to kind of increase the profitability of the company. The next report we're looking at is the shareholder's current account, also known as the director's loan account. And I know in the SME market, particularly, the difference between the shareholder and the director becomes largely blurred, as they are essentially the same person in a lot of cases. And this shareholder current account, first of all, offers a running record of funds introduced and taken from the business by shareholders. It's also a way of monitoring personal expenditure made from the business, although I would recommend kind of eliminating that practice from your business, because we don't really particularly want directors not differentiating between the business's cash and their own cash. It becomes quite messy from a bookkeeping point of view. Also, it ensures a record of the different balances for each shareholder that's maintained and how much is owed to them at any given time, be it money owed by the business to the shareholder or shareholder to the business, which is known as like an overdrawn loan account. Just a quick note on an overdrawn director's loan account is that ultimately these need to be repaid as quickly as possible, if it is feasible, and that can be done in a couple of ways. You can either simply just repay the loan balance from your personal account, easier said than done, I can imagine. Alternatively, you can offset it against payments owed for remuneration. So if you have a salary for the business or you're claiming dividends, that's one way of possibly offsetting it. That obviously, the remuneration option obviously has some tax implications, because you'll need to be putting your salary through a pay-as-you-earn scheme for the business, or obviously the dividends will have a personal tax effect. So even though you're not getting paid those dividends, you still have to declare them on your tax return. And obviously dividends are dependent on the on the company's retained earnings. So if they haven't got retained earnings, then you can't be giving out dividends. The other side of it, though, is if you don't repay your overdrawn director's loan account, then there is going to be some tax implications as well. It'll affect the corporation tax that your company would pay, as well as potentially having a P11D benefit issue for you personally and for the business. So I'd recommend, if you can, clearing any overdrawn director's loan accounts. If we look at the shareholder current account for Foodco, we can see that at the start of the period, the company's sole shareholder, Mr. Doe, was owed just over £29,000. He's since introduced an additional £2,000, either through a straight capital injection, or he's possibly incurred some business expenses personally. On the other side, he's also drawn just over £9,500 through general drawings and his life insurance payments, resulting at the year end being owed just under £22,000. So the amount owed by the company to Mr. Doe can only be repaid if the company is solvent and has the cash available to make those repayments. But as we know, that Foodco at the moment is insolvent, showing net liabilities of £305,000. But as I said before, I feel like this £22,000 should almost be knocked off the £305,000, because ultimately, if Mr. Doe has the best interests of the business at heart, he won't be actively chasing this money owed to him. But though I appreciate that even if you did knock the £22,000 off 305, it's still, the company's still incredibly insolvent. So to ensure that the company will be able to repay these funds introduced, ideally the company needs to be embarking on some kind of profit improvement strategy. And as we've seen with the work that they've done with their accountants, that rather small adjustments in terms of percentage terms can have a significant improvement on the profit figure. I mean, we saw £138,000 worth of improvement just through a few changes in strategy. So ultimately, it is feasible. The only thing that possibly Mr. Doe will need to consider is whether he's willing to inject that £305,000 worth of cash into the business to get it into a position of solvency again. And I think the directors will probably have to present their strategies to him in order to persuade him and put his mind at rest that possibly his cash will be safe and he will get it back. So the last report we're looking at is the fixed asset register. Again, some of you may be familiar with it, also known as the depreciation schedule. This is kind of where we record your fixed assets held by and owned by the business. So standard ones of these are kind of your land and buildings, your vehicles, plant and machinery. Ultimately, anything that generates income for the business or facilitates the generation of income, which has a useful life of greater than 1 year, is considered a fixed asset. The fixed asset register also facilitates the spread of costs of those assets over the useful life via depreciation. I'm sure everyone's aware of depreciation, either in accountancy terms or in general life. It's amazing how much cars depreciate, for example. I'm sure everyone's aware of that. Thirdly, the basis of keeping track of your business assets. So it's a very good control for preventing theft. So if you have a record of what all your assets are, then it's going to stop people from, employees or customers, suppliers, or people off the street coming into your place of business and stealing your assets. You're not realizing for 2 or 3 years when you're trying to look for a laptop or something. It also provides a useful guide to an annual asset replacement budget. So if you set your depreciation rates for various assets to the point where they're no longer valuable, then you'll know at some point down the line that needs to be replaced. So if you have a laptop, for example, that you bought and you're only going to use it for 3 years, then you'll know that in 3 years' time that you're going to have to spend some money to buy a new laptop. Finally, the fixed asset register is quite helpful for, sorry, I jumped ahead again. It's quite useful for when you are selling your business, because ultimately your fixed asset figures will be reflected on the balance sheet, and the balance sheet's another key report which is used by potential buyers of your business for valuing purposes. So that makes it even more important that you get your depreciation rates correct, so you actively reflect the value of your business at any given period of time, at any point in time rather. So if we jump ahead into the fixed asset register for Foodco, we can see on the first column here, we've just got a description of the different asset types, motor vehicles, office equipment, and then under that there's a description of all of the various assets that they've got on their register. The second column is the cost of those assets at the date of purchase. And then the next column here is the opening value of the asset, which is essentially the cost of the asset less the accumulated depreciation from previous periods. The next two columns relate to the purchases of new assets and the disposal of old ones. So the disposals can be if you've actually physically sold that asset on, or if it's just got to a point where it's no longer a value, then you can dispose it off your fixed asset register. The next one is the rate and method of depreciation, which I said was quite important because it needs to actively reflect the useful life of that asset. You can see that in Foodco's case, they're using the diminutive value method, also known as the straight line method, which is essentially a percentage of the cost of the asset, which is taken off the value of the asset every year until it reaches zero, essentially. There's another method of depreciation known as the reducing balance method, which some of you may be aware of, but I won't bore you with the details of that. It's not very exciting. Next, we have the depreciation charge for the year, as well as the closing accumulated depreciation, which will reflect what will be taken off the value of the cost to reach our closing value. And ultimately, that figure there within the closing value is what's going to be reflected on our balance sheet. So that was kind of the whistle-stop tour of the 6 different reports. As I said, each one of them had some very useful, hopefully had some useful insights for you, and kind of showed why they're important to be constantly reviewing and checking over time to kind of see where the to gain valuable insights into the business. And now we're kind of jumping into the difference between profit and cash. So this is a nice little, I would say a rhyming couplet, but it's 3 of them. It's a rhyming triplet. But I feel that it's quite apt. So if you think about it, turnover's always the figure that's used in the press, in newspaper articles, or articles on social media. Everyone's read the clickbaity articles where it's school dropout is now worth X millions of pounds after he was told that he was a waste of space by his teachers. And then you go on to read the article, and it turns out that they're valuing him based on the turnover of the company that he runs, which would be lovely, wouldn't it? I mean, I'm sure everyone here would love to quite happily take home their turnover values that they got from their business. Profit levels, essentially, it is essentially a sense check on the business. So it's kind of reassuring you that you've got your sums right, you've got your margins right, and you've got enough space to pay all of your overheads, and ultimately you're getting some money out of the business at the end of the day. And then finally is cash flow, and I think cash flow is probably the most key one. I mean, I can appreciate a lot of business owners get frustrated that their turnover figures are good, their profitability figures are good, but it's not reflected in their cash balances. And some of them just can't get the head around that it's ultimately not the same thing. I mean, in reality, though, there have been plenty of profitable businesses that have gone out of business because they just couldn't get access to cash. They were starved of it and they couldn't pay their debts. Likewise, there's plenty of loss-making companies that have survived for years because they're able to get access to funding. So it's important to get that distinction, which was what we're going to look into next. So to demonstrate the difference between profit and cash, I just want to consider a few different items which may affect one or the other or both. So the first one is VAT. Now, if you think about it, VAT obviously you have to be a VAT registered business, but if you are a VAT registered business, then your VAT figure, your profit and loss figure is at net of VAT. So VAT never comes into factor into your profit figure, but obviously VAT has to be paid out. The VAT that you receive in relation to sales invoices against what you reclaim against purchase invoices, that balance needs to be paid over to HMRC. So that affects your cash, but not your profit. Similarly, loan repayments. Again, when you receive a loan, that ultimately sits on the balance sheet as a creditor. It doesn't go anywhere near the profit and loss account, which then means that subsequent loan repayments affect your cash balance, but not your profit. Interest on loans, however, affects both profit and cash, because the interest element on a loan is a tax deductible expense, so will affect your profit, and also obviously makes up a portion of those loan repayments as well. When you're on a capital and interest repayment scheme, so we can see that it will affect both your cash and your profit. Asset purchases, again, this will ultimately sit within your fixed asset schedule. So as a result, goes nowhere near your profit and loss account and only affects your cash. Asset sales are slightly more complicated, and the slide probably doesn't accurately reflect what that it affects profit and cash. It's only showing as cash, but essentially, if you do sell an asset for cash, then it will also affect your profitability figure, although it doesn't affect it significantly. So the main effect will be affecting your cash balance. And finally, depreciation. And this is obviously a non-cash adjustment, just to reflect the accurate spread of the cost of an asset over its useful life. So that will affect your profit figure, but not your cash figure. So as you can see, even a profit that kind of achieves even a business that achieves a healthy profit may not necessarily be making lots of cash, because they may be paying tax repayments, making loan repayments, or buying new assets, which will obviously be sucking cash out of the business. The next thing we're going to look at is the Business 101 cycle, which is another useful way of demonstrating the difference between profit and cash. So if we think about it, the first step in the life cycle of a business is that an owner invests money within that business. This money is then used to purchase assets to generate income within a business. In some cases, they may seek additional loan finance to buy off some of those assets. But ultimately then those assets are put to work and they start to generate profit. And as you can see, you can increase your profit by growing your sales or margins, but you can also lose profitability through overheads, and if they're not managed correctly, then you're obviously going to move into a loss-making position. However, provided you remain in a profit-making position, then it makes sense that ultimately cash will then be generated into that business. And their potential drains on that cash can be when your credit control is slow, or you've got lots of stock tied up, lots of cash tied up in your stock, or you're having to make these loan repayments or significant tax repayments, or you're not fully exercising your credit terms with your suppliers and paying them too quickly. And obviously on the other side is better credit control, better stock management, fully maximizing your credit terms with your suppliers, and kind of reducing your tax through a bit of tax planning. So provided then we're getting cash into the business, and there's not any significant drains, then the owner should be in a position then to draw some of this money out of their business. And this can be done through drawings, dividends, or to service their personal loan repayments if they had to take out any personal loans to fund the original capital put into their business. And ultimately, what we want to see is this cycle happening quicker and quicker and accelerating and increasing your return on investment for the owner. So after cash flow, the business value is probably the most important measure within business success. The one thing I can say is that these key drivers are different for every business, not one size fits all. Obviously, the metrics in place for someone within healthcare is not necessarily going to be the same as someone who's a window cleaner. But one thing that has in common is that you just need to know knowing yours is kind of the essential piece. And we've got some examples of potential key drivers, be it on a monthly recurring revenue if you're largely on a subscription sales base, or revenue growth, or revenue by client, or just a general looking at sales and profit levels. Ultimately, if you're not sure of what your key driver is within your business, then feel free to reach out and we'll help you kind of understand that and get something in place. So, how do we enhance our business value? Well, the first step is in developing and implementing a clear plan and documenting your organisation structures and roles within the business. These plans don't necessarily need to be exhaustive. We in the Business Accelerate department tend to encourage the use of the one-page business plan method, which, as Gemma mentioned at the start, was kind of using this now, where, how method. Ultimately, it's a 90-day document which notes where the business is currently and where it wants to be, and develops kind of focused strategies and individual action points which can be achieved in the time frame, setting accountability for certain individuals and giving them deadlines to achieve them. And ultimately, these action points will then hopefully close the gap between where the business is at the moment and where they want to be. Secondly, and again, apologies about this because I'm banging on about it again, it's establishing cloud-based real-time reporting, so up-to-date and accurate information. I'm going to keep hammering that home. And also alongside that, reviewing and documenting your systems and processes and constantly looking for improvement. I would always encourage getting feedback from as many people as possible within the business when developing those processes, getting the people that ultimately do the things that they're meant to do, getting their feedback on how you can improve it is always a good thing. In terms of recommendations for cloud-based software, we at Robson Laidler are a big fan of Xero. But obviously, if everyone else will have their own preferences. The next point of adding or sort of enhancing business value is reducing the reliance on the business owner, as it kind of helps enhance the value, and it's easier for new owners to kind of get their feet under the desks. We've done seminars and webinars previously on the 10 hats of business, which some of you may have been at, which I apologise because I'll just do a quick whistle stop of that. Essentially, there's a study which shows that every single business, no matter what size or what they do and the industry that they work in, have the same 10 departments. And it basically means that in a smaller business, which can't afford to necessarily employ specialists to service every single one of these departments, sort of HR and finance, etc., means that they have to get involved and spend more time working on these departments and ultimately not working on their business. They're tied up within the admin. So we see that a lot of businesses, small businesses, don't necessarily have any value because the value is tied up with the business owner, and the amount of work that they have to put in and the relationships that they keep personally can't necessarily offer any tangible value to somebody who was selling their business. So it's really important to kind of reduce that reliance as much as possible and maximising the tangible value of the business. And finally is identifying and managing risks. This means that you can mitigate them before they become an issue. I know it's easy to be stuck kind of looking at the here and now, trying to clear your desk, write your emails, just get through the day. I've been there myself. But if you can take some time to kind of pick your head up and look forward, then you might be able to see stuff ahead in the future, which you can mitigate against, rather than, to continue the metaphor, if you're still looking at your feet, you're ultimately going to trip over them without realizing, which can obviously be more difficult to sort out. We're looking at kind of protecting your assets. Throughout the webinar so far, we kind of looked at profit and cash flow and the value of your business and how it kind of affects you personally as a business owner. Ultimately, your financial security and work-life balance is the first thing that gets sacrificed when your backs are against the wall and the business is struggling. However, there are some ways of protecting your assets. A lot of them, I imagine, you'll be aware of. So the first thing is limiting your liability. So this is either through setting up a limited company or a limited liability partnership, which will limit your personal liability for a business to the amount that's originally invested. Only in extreme scenarios where there's been some foul play will necessarily the veil of incorporation, as it's called, be lifted, and you'll be personally liable for debts incurred by the business. Next is the directorships. So ultimately, who you want to be a director, a decision maker of the business, and whether those directors should be holding any business assets personally. Another consideration of directors is that ultimately they have statutory duties under company law, such as preparing the accounts and ensuring that there isn't any fraud within the business. So they are held personally liable for that. So that's another consideration when you want to be picking directors. In terms of security for loans provided, it's simple as kind of, if you're loaning money to anyone or even to your own business, make sure that you have some security over those loans. Also, there's ownership options, and we've talked about of high value assets, and we've talked about how directors may want to hold assets personally, but there may be some higher value assets which you may look at a more complicated corporate structure, because ultimately I believe the statistic is that most businesses go bust within the first 3 years. And if you want to protect any assets that the business, any assets that you have within the business from being taken from you if the worst does happen, then looking at maybe keeping assets within a separate legal entity might be the way forward. Terms of trade and credit policy, so ensuring that new customers are subject to credit reports and credit limits to mitigate the risk of bad debts. Insurance policies as well, obviously give you some financial security when the worst happens. So business interruption insurance, which I'm sure if anyone had them during this current crisis will be very relieved that they've got it. Likewise, there'll be indemnity insurance for if there's any particular issues with the work that which you may get sued for if the work isn't done to a satisfactory level. Financial planning. So it's important to think that the financial management doesn't just stop at your business. At the point where you take money out of your business, you can still find ways of getting your money to work for you, and there's some various investment vehicles that you can use. And I would encourage you to seek any professional advice in relation to personal wealth and financial planning. And finally, estate planning, which I know is a bit morbid, but ultimately we always want to be looking at what's going to happen in the future, looking at succession planning, how selling your business may look like, any inheritance tax planning, wills and probate and power of attorney things. So ultimately it's never too early to start planning and getting those things in place. And coming to my favorite words, best practice, which we've talked about a few times. what I would say is that effective and productive businesses have, among other things, a lot of things in common. These three tools are kind of the crux of it. So producing an annual business plan, as I've said before, it doesn't necessarily need to be a 1,000-page document which you need to constantly be updating. It can be as simple as a one-page plan which you refer back to on a monthly or quarterly basis, and just continue chipping away on the short term on individual actions. Also an annual cash flow forecast. As I said at the start, it's always great to have that ambition and kind of set out where you want the business to be. And I also said that I appreciate that COVID and Brexit is making it incredibly difficult and uncertain, that to the point where a lot of customers don't even know what's going to happen, or a lot of clients don't know what's going to happen in the next 30 days, let alone what's going to happen in 12 months' time. But it's still an incredibly important practice to maintain. And then the last thing is ongoing reporting and accountability. So you're constantly comparing where you are, or where you want to be, or where you're expecting yourself to be. You're flexing your plans and your forecasts to the business environment. One thing I can say is that I know it's very hard to stay accountable to yourself as a business owner or somebody who's senior up, who has no one to hold yourself accountable for. I appreciate things get in the way of good intentions, and there's probably a lot of very good ideas going through a lot of your heads, which you'd love to actualize, get down on paper and get achieved. And this is kind of where the coaching tool is quite important, as this is amazing how much more you can fit into your day when you're held accountable to a promised action. I mean, the best comparison you can give it, well, isn't necessarily school, because a coach isn't a teacher, but the accountability of you doing your homework wasn't, if it was up to you, you probably wouldn't have done it, but the fact that you were held accountable by your teachers and your parents meant that you ultimately got that done. So very, as I suggested, the title of this webinar is slightly misleading, because although we have looked at some of the maths, it's very much just the beginning. It kind of helps you on your business journey and kind of developing really good practices. So next steps, where do we go from here? Well, my job is to help you take away what you've learned from today and implement some positive changes in your business. So let's do a quick coaching exercise. I mean, I challenge you to kind of pick 3 actions or projects that you think would add value to your business right now and give some benefit. Don't be disheartened. I know that it's easy to kind of hide away from problems, but ultimately you can flip that around and look at a problem as an opportunity to create a project. And a lot of improvement comes by solving projects rather than making improvements in areas that you're already strong in. And the most important thing to basically take away from this is doing nothing is not an option now. Things have changed so much over the past 6-8 months that standing still is a very dangerous thing to do. So in terms of how we can help you, I mean, hopefully you've got some value out of this session, and some of you will be fired up to go away themselves, and our one-page business plan template is available on our website, on our Business Accelerator page. For those who are unsure or would like to have an idea of, someone to hold them accountable for creating some change in the business, then we do have some offerings for you. First and foremost, we have a free introductory session, which gives you a taster to how we operate and how we use some of the tools with you within our business strategy services. And from there, that can lead on to a business planning session where we can pull together a one-page plan with you. And then from there, we also have monthly and quarterly coaching packages, which can, again, maintain that accountability, which are on a monthly retainer fee. We also have specific cash flow services, be it one-off forecastings, or we can do ongoing coaching, as Gemma said, specifically aimed at cash flow. Ultimately, we don't want to be too prescriptive with our services, as we know that your business problems are unique. So if you have any questions or inquiries, so feel free to get in touch. If funding is an issue, There is some support available to you. This is open to you regardless of whether you take up any of these services with Robson Laidler. The NEL fund is offering unsecured loans and various investments through their small loans fund and their capital growth fund, which you can apply for. And we're happy to help you pull together an application for that. More than happy to do that. Likewise, there's some specific COVID-related funding which is being done through the North East Growth Hub. I'm sure some of you are also aware of the announcement of the government funding in relation to local lockdown restriction funding, which was announced at the end of October. We're still waiting for the details on that, but it sounds like it will be handed out by local authorities based on the rateable value of the premises that you operate from. But we're going to try and keep everyone posted on that as and when the details come out. We also have a couple of partnerships with various funding platforms. If you are seeking any kind of finance, I know the big thing at the moment is a lot of people are refinancing their bounce back loans into CBIL loans. So again, feel free to get in touch with us about that, and we can walk you through the process. And obviously, that won't cost you anything either. I talked a little bit about values at the start, and I thought it was important that we show the Robson Laidler one. One of the Robson Laidler values we have is making an impact, and we've partnered up with the global Buy One Give One initiative with the UN, which is helping provide meaningful impacts across the world. So for everyone who's attended today, we will be providing 6 days of access to e-learning for children in India. So that should be a nice warm, fuzzy feeling for you, at the very least, for sitting through my ramblings. So that is very much it. I am open for questions if anyone has them.
Thanks so much, Jack. That was really a great presentation, expertly delivered, and a lot of techie information in there. If anyone does want to know more, I know Jack covered a lot in a short space of time, so we do have a guide available, so I'll email everybody afterwards with that guide. But if anyone does have any questions, feel free to just switch your to unmute yourself and switch your camera on and come forward and ask a question, or type it in the chat box. While you're just having to think of questions, I did have a couple emailed Jack.
Okay.
Oh well, should we answer Vishal's? Can you see that, Jack, that question?
I'm just trying to pull it up now.
Oh, it wasn't a question, actually.
Okay.
You've given him a lot to reflect on, so that's great.
That's great. And obviously, I'm happy to pick up anything, and my contact details. Are they going to be going around, Gemma?
Yes, yeah, I will. When I send the guide round, I'll send your follow-up information as well.
So yeah, I'm happy to have a chat with anyone if anything specific came out of this presentation.
Okay, yeah. I did have one question on the email, Jack, if that's all right.
Yeah, sure.
Do you want to switch your camera on so people can see you?
Yeah, sorry.
You can. The question was, what is the difference between markup and margin?
So, markup and margin, good question. They are very, very similar. So I can appreciate there's some confusion about them. Margin is essentially the profit you make in relation to your sales price, whilst markup is the profit in relation to what you bought it for. So a very simple example is if you buy an item for £75 and sell it for £100, you've got a profit of £25. Your margin will be the £25 divided by 100, so that's 25%. But your markup will be the £25 divided by 75, so it'll be 33%. So it's essentially measuring profit, but it's in a slightly different way. So it's a slightly different percentage as a result.
Okay, that's great. And another question that was just emailed through is someone who uses a company for management accounts said, what's the main difference between using somebody for management accounts or just end of year annual accounts?
Yeah, good question. There's a few things. So there's a compliance element. Annual accounts, obviously, you're obligated to provide them by Companies House and by HMRC for your corporation tax. Whilst management accounts you aren't obligated to do them. They're purely for management purposes. Another reason is the timing of them. So annual accounts have to be prepared on an annual basis based on the year end of the company, whilst management accounts are more aimed at in real time. So you're looking back on monthly figures or quarterly figures. And with the rise of cloud software for accounting purposes, that you could be very much in a position where your month-end accounts can be turned around in a matter of days. So it's ultimately kind of closing that gap between the information, and we've talked a lot about, and I've been banging on about up-to-date and accurate information. That management accounts really facilitate that for clients, and it's something that you can do yourself, but also you can't undervalue the services that you can get for management accounts for running a business.
Okay.
Yeah.
Okay, that's great. Thanks, Jack. Okay, well, everybody, if nobody has any questions, we will love you and leave you there. I've got everybody's details, so I'll send around the guide, and any questions, just catch up with Jack. Okay, thank you, everyone.
Thank you very much for your time, everyone.
Thank you so much. Thank you.
Thanks.
Bye.
Bye.